Today, the corporate backlash to last Wednesday's deadly riots continue as fintech companies stop processing payments for the Trump campaign and some of its supporters. Plus, with the COVID vaccine rollout going slower than planned, the CDC expands its eligibility requirements. And finally, the bond market has made big moves in the opening weeks of 2021. We dive into the rise in government yields and what it could mean for stock investors. I'm Mackenzie Sigalos, and this is CNBC After Hours. Stocks closed the day in the green as the Dow, S&P 500, and NASDAQ all finished marginally higher. But the talk on Wall Street today was mostly focused on the bond market. Now, U.S. government bond yields, which is the interest that investors are paid for holding U.S. debt, well, those yields rose to their highest levels in months today. The size and speed of the rise in interest rates could have implications for the broader economic picture, which in turn affects positioning in the equity or stock market. Now, CNBC.com's finance editor Jeff Cox explains why everyone made a big deal about rates today.
What we've seen so far in 2021 has been a sharp rise in government bond yields, particularly on the longer end of the curve. The 10-year yield and the 30-year bond have both gone up considerably. Just since the beginning of the year, we've seen moves of over a quarter point. So that has really gotten the bond market's attention. It's not something that we're used to seeing, particularly in this age of where the kind of Federal Reserve does a lot of things to try to control bond yields, where we see very, very low inflation. We could just kind of generally in an era where the expectations are not that great for economic growth. It's been all the more remarkable just to see how the bond market has reacted in such a short period of time. I think the blue wave in Washington has a lot to do with it, and I'll explain why I think that that's driving this move in yields. We were looking at a kind of a split Congress. The idea was that, yes, there will be more stimulus in the pipeline, but there will not be dramatically more stimulus in the pipeline. Now we're looking at President-elect Biden talking about stimulus that's going to be in the trillions of dollars. So I think when he said that, that really shook the market a little bit and said, hey, wait a minute. This kind of state of affairs that we thought we were going to be looking at has just changed dramatically. You're seeing anticipation of inflation coming. You're seeing anticipation of just bigger growth period coming. So the trade that originally created this move to bonds has reversed itself. And what that trade was basically just a fear trade. Everybody went out, wanted to buy bonds and just kind of ensure preservation of capital. The conventional wisdom would say rising bond yields mean bad news for the stock market. What happens when yields start to rise is it starts to make things more expensive, and it makes debt more expensive. This is a really debt-fueled stock market now. If corporate debt is very, very cheap right now, if that changes, it changes the whole dynamic of corporate profits. The question is going to be, why are yields rising? Is this anticipation of something bad like runaway inflation happening, or is this just something because growth is coming back and bond yields are going to start getting back to a normal level? The Fed, of course, is always going to be the wild card in all of this. These kind of moves in the bond market will get the Fed's attention. The Fed is the man behind the curtain. You know, they are the ones who are kind of pulling all of the levers here. And the Fed has a number of levers that it can pull in this kind of a situation.
Okay, let's get to our sound check. Here's a roundup of the day's biggest action and what the top newsmakers and business leaders had to say on CNBC's airwaves.
In the offline world, it's pretty obvious. You can't run into a movie theater and yell fire. You can't walk into an ice cream parlor and start shouting racist epithets and continue to expect to still be a customer of those establishments. Well, online companies are essentially doing the same thing.
Right now, I think we have released 33 million doses. And we have, let's say, half of what we have manufactured is sitting on the shelves here.
I'm probably not the right person to ask of what Apple's plans are, but we consider them to be a formidable competitor. So that's why we're working with all the capability we have with our technology to go as fast as we can to really satisfy and delight the customer in our vehicles and create that relationship and just an incredible overall ownership experience.
I think we're all still really understanding what's happening in the market. I will say that there's a lot of enthusiasm around sort of the PC form factor. And so the idea that there is some pent-up demand that will continue to exist into 2021 is probably what you'll hear from the entire PC ecosystem.
All right, so the corporate backlash to the deadly riots on Capitol Hill last Wednesday has continued into this week. Tech companies and social platforms have really tamped down on violent content. I mean, President Trump's account has been removed from both Facebook and Twitter. The Google and Apple app stores have booted Parler, the quote-unquote free speech platform that has attracted many alt-right users. And Amazon kicked Parler off its web hosting service, AWS, which has effectively taken the company offline. Now, Parler has sued Amazon in response to that action. Trump himself today said that the tech companies are making a big mistake here.
I believe it's going to be a catastrophic mistake for them.
But it isn't just social companies taking substantial steps. Many corporations have issued statements condemning last week's rioting, with some pausing all of their political donations. And others, well, they're going further and punishing the Republican politicians who encouraged the false election fraud theory to spread by objecting to the congressional count of electoral votes. Now, in addition to all of this, payment companies like PayPal, Stripe, and Shopify, well, they're cutting off the Trump campaign and some of its supporters who participated in the riots. CNBC's Kate Rooney can explain the Fintech fallout.
Fintechs and credit card companies are taking slightly different stances here. We had PayPal and Shopify banning payments and closing accounts for certain Trump supporters that financed those riots in Washington last week. They say that was for violating policies about inciting violence. Stripe, meanwhile, cut off the president's campaign account for the same reason they say violated its policies against encouraging violence. On Monday, the credit card companies, you had American Express, Visa, and MasterCard, responded to the situation, but in a slightly different way. Visa paused all political donations. MasterCard and American Express paused political donations for Republicans who objected to the Electoral College vote. Analysts tell me the card companies really aren't in the business, they say, of passing moral or political judgment. They will most likely wait for law enforcement to determine which groups were involved, use due process as a test for deciding whether or not to suspend or to shut down payments. Visa said it does not tolerate illegal activity, but for a little context here, it's really up to the banks who hold that relationship with the merchants to investigate any allegations. The payments companies getting involved in some senses could be even more impactful than social media. Cutting off President Trump's access to money in some senses and funding, and any funding or support around certain rallies is huge. It can't be understated. The card networks are taking a different approach, but companies like PayPal, Shopify, cutting off access to funding is seen as a massive move.
Okay, time for today's numbers round. We'll start with $1 billion. The NHL expects its revenue this season to take a hit of at least $1 billion. On a call with reporters, the league commissioner, Gary Bettman, explained that he doesn't anticipate that fans will be allowed back in the majority of stadiums during the abridged 56-game season that begins tomorrow. In fact, he said it would be cheaper for the league to, quote, shut the door and not play. Next, 65. Today, the CDC expanded COVID-19 vaccination guidelines to everyone who is at least 65 years old. A senior administration official told CNBC that the state's focus on vaccinating healthcare workers first, well, it's created a bottleneck and slowed the overall rollout. Because remember, the administration's effort is being run by the states, not the federal government. This new expansion from the CDC is merely a guideline, but that doesn't mean it won't be heeded. Already today, New York State has said that all of its residents aged 65 and older are eligible for the vaccine effective immediately. And finally, 438. Shares of a little-known device manufacturer called Signal Advance soared 438% yesterday, entirely by mistake. So here's what happened. Tesla CEO and heavy Twitter user Elon Musk tweeted, quote, "Use Signal," a reference to the popular encrypted messaging app. Musk's followers wanted to capitalize on the endorsement from the new richest person in the world, and they all raced to invest in this company. But here's the problem. Signal, well, it's not a publicly traded company, but Signal Advance is. Eager investors began furiously buying the wrong stock, a tiny company with just one full-time employee and shares that trade over the counter, meaning that they aren't listed on a formal exchange like the New York Stock Exchange or NASDAQ. Just to give some context, the day before Musk's tweet, Signal Advance stock closed at 60 cents. Yesterday, shares reached a high of around $70. More than 2 million shares changed hands yesterday, while 1 week earlier, on January 4th, not a single share of the stock was traded. The confused investors appear to have identified their mistake. Signal Advance is down more than 50% today. Our tech desk wrote all about Elon's mixed signals, and you can check out the full piece on CNBC.com and by downloading the CNBC app. And that's it for After Hours. We'll be back here in our home office every Tuesday and Thursday, so be sure to catch us then.